Welcome to the May edition of the Balanced Perspective with me, your host, Mansoor Naka of Nedgroup Investments. On the line, we've got Iain Power, the CIO of Truffle Asset Management. Welcome, Iain.
Hi, Mansoor, and welcome to everyone joining us today.
With global bonds coming back to the fore in recent times, today's topic will be exploring the opportunities and dynamics of the global bond market, more specifically, emerging market bonds. So I think to jump straight in, Iain, outside of China, where we haven't quite seen a full recovery yet, I think maybe first to take a step back, how does the fundamentals of emerging markets at this point in time stack up against developed markets?
Mansoor, I think what you saw from emerging markets this cycle, and I'm talking about the rate hiking cycle, is they were a lot quicker out of the blocks to respond to inflation than what we saw from particularly the US and some of the developed markets where there was a view that inflation would be transitory. So I think, given those EMs came out quite quickly and pushed up rates and responded pretty quickly, they today are in a position where all they're waiting for is confirmation from developed markets that they can start to cut. And basically what it means is we need to see the US get to a point where we really know the next move is down, which will then enable everyone to start cutting rates. And I think whilst we've seen one or two emerging markets actually cut rates already, it's difficult for them to meaningfully reduce their interest rates whilst US rates and other developed market rates are still high because of the impact that will have on their own markets, capital flows, and their currencies. So the way I like to sort of think about it is you've got all the EM markets, basically athletes on a 100-meter track waiting for the starter's gun. The starter's gun is the US, it's the Fed, and effectively the big uncertainty here is when actually do we get these rate cuts. And I think given the issues that we've spoken about at length in the US, high fiscal deficits and the US government supporting and adding lots of growth to that already hot economy, it's really just making that last mile of inflation for the Fed down to 2% a little bit harder than they thought. So, maybe the first rate cut is going to be kicked out a couple of months. I'm pretty sure we're still going to get it. And the other point I'd say is that, forecasting economic outcomes is fraught with danger, and rates in the US are high and they are slowing down that economy and are having an effect. And sometimes what happens, if you just look at history, is that effect can suddenly accelerate. So I think we effectively in a position here where all we're waiting for is confirmation from developed markets and the Fed, and you've got lots of value on the table across many of these emerging market bonds, and all we're waiting is to hear that crack of the pistol, and I think they'll be down the track.
Thanks, Iain. I think coming specifically to emerging market bonds now, emerging market bonds delivered strong returns in 2023. I think if we look at, just the government sector of emerging market bonds, somewhere around 12% in US dollars. Does the outlook for emerging market bonds still look constructive, and what would those drivers be that would, eke out those further gains for us? You mentioned, inflation seems to be a challenge still, I think, in developed markets, but seems to be tapering off quicker in EMs, giving central banks there more room to cut.
I think that's right. I think as you've sort of scripted it there is really what we're looking at. We're looking at lots of good value in terms of starting yields. So the yields are pretty high. And I think EMs generally don't have an inflation problem. There's obviously one or two little examples, but I think generally they don't have the same inflation issues that developed markets have, because we don't have the same asset bubbles that some of those developed markets have, which is causing that inflation, particularly in the property market for those big DM markets. So I think that looks pretty good. And then on top of that, once you start to get US rates moving down, I think what that does is you then start to see the benefit of the currencies also start to come through. So it's not just the starting yield, but you will start to see that the emerging market bonds in local currencies will probably deliver pretty good returns given the fact that those local currencies are likely to strengthen. So I think in dollar terms, when you sort of look at those returns, basically it means that we think that the dollar will weaken vis-a-vis some of those EM currencies, which means your returns then become supercharged in dollars. So I think I think the setup looks pretty good, and certainly we've been positioning in terms of some of our exposures towards those EM assets offshore and in the EM bond markets, and basically we're just waiting for that crack of the starter's pistol, and I think there's some good returns to be had. I think the other point I would just mention is that the base of the yield curve, which is the US long rate or the US 10-year rate, we think that is, risks to that number are now starting to decrease to the extent that, the economy will start to slow. And I think at some point you'll then start to see that 10-year treasury slowly start to move down, particularly if we start to see the economic weakness become a little bit more pervasive into the back end of this year or into the early part of 2025. So I think that all bodes well for EM bond returns.
And of course, I think also with elections being quite topical, of course, South Africa and around the world with so many elections happening at the same point in time, are there any countries specifically that you're sort of worried about, maybe outside of South Africa in the EM space?
So I think, look, every country has got its own nuances. I would say from a fiscal point of view, South Africa is certainly a little bit more risky given our expenditure versus our tax receipts. But I mean, generally, even when one looks at Brazil, notwithstanding some of their issues, it looks like there's still pretty decent yields to be had. So, emerging markets, I think, generally are not in bad shape. And I think one is talking, I'm putting China to one side. I think China is sort of a discussion on its own. But I think generally the emerging markets are not in bad shape and have lots and lots of scope to cut rates, no inflation problem. And you've got commodity prices which are starting to move up on the back of a recovery in the global manufacturing cycle, together with perhaps some issues or concerns around supply this time, which I think all bode well for some of these resource-focused EMs. So I think that sort of story probably continues, particularly once we start to get the first rate cuts, and we think, that probably happens in Europe and will be followed later in the year by the US, which then I think sets up these EMs, as you correctly said, for some pretty decent returns, both in dollars and in local currency.
Coming back locally now, and you just touched on this, SA bonds still offering very attractive yields, but something that you and the team have been worried about for quite some time is, of course, as you mentioned now, the fiscal risk that we face in South Africa. Has this changed or improved somewhat?
No, I think the long-term fiscal concerns are certainly still there. Obviously, to the extent that if we have a positive cycle from a commodity point of view, maybe that then improves that in the short term. But I think the concerns for SA are more around the ability to improve economic reforms and infrastructure. And the long and short of it is you cannot be growing in nominal terms at round about 5-6%. When your interest rates that you're borrowing at are almost double that. I mean, effectively what it means is you continue to leverage the country's balance sheet. So either we cut back on expenditure or we've got to improve our growth prospects. One of those two things must happen. And I think that's one of the reasons why we've been taking our fixed income EM trade more offshore and playing it that way, where we then get exposure to the cycle, but without the SA idiosyncratic risk that is, continues to build locally. I mean, it doesn't mean to say that we don't think you'll get good returns in the cycle from our fixed income assets this year, but certainly there are risks around that, which you don't get the same sort of risks when you're looking at some of the global EMs or some of the other emerging markets where returns are sort of equally as attractive.
Iain, thank you so much. I think we leave it there. We are almost out of time, but of course, Lots of nuggets coming out, the wealth of wisdom that you share with us every month. We appreciate you and thank you so much. Till next time, goodbye.
Thanks, Mansoor. Bye-bye.